A subprime mortgage is a loan granted to individuals with lower credit scores. Let's look at why these loans exist and how they work. The term subprime refers to a borrower who does not qualify for the best interest rates due to a limited credit history. While standards vary, lenders often use credit scores below 620 as a baseline for identifying subprime applicants. These loans carry higher interest rates to compensate the lender for the increased risk that the borrower might default on the payments. The main difference between prime and subprime is the risk profile, which directly dictates the interest rate and the cost of borrowing. Higher rates mean that subprime borrowers pay significantly more in interest over the life of the loan compared to prime borrowers. Remember that subprime lending is a standard financial practice, though it carries more weight during periods of economic instability. Understanding these lending terms helps you navigate the housing market with confidence. Thanks for watching, and stay informed.